the best of Money Matters.
Market View on Money FM 89.3.
You're tuning into Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. While the Singapore Straits Times Index set a record today as it crossed the 4,000 point mark for the first time in early trade. So the index hit 4,005.18 points shortly after the market opened, and this surpassed its previous record of 3,991 points clocked on the 27th of March. Now let's take you through how the Singapore stock market ended the day. The STI closed in the red though, down 0.23% at 3,972 points at the close. In terms of value turnover, we're looking at 1.32 billion Sing dollars. Gainers trailed losers 230 versus 251. Top advances for today we've got for you Shangri-La Hong Kong dollars, SGX and SBS Transit. And top decliners we've got here GMX USD, New Incorporation USD and PC Partner. Now in terms of companies or counters to watch, we have Sinarmas Land because an entity controlled by Indonesia's billionaire Widjaja family called Lyon Investments, it made a voluntary unconditional cash offer for all the shares in Sinarmas Land that it does not already own at 31 Singapore cents apiece. Now, elsewhere from Trump's tariff plans propelling the safe haven gold to a record high, to Hong Kong's derivative trading surging to highs previously not seen, we've got more international headlines in focus. And joining me on a Friday is Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, how are you?
I'm great. How are you?
Good, and an important and a good day for the Singapore stock market as well, particularly early on with the Straits Times Index crossing the 4,000 point mark for the first time. Now, the STI fell below the 4,000 mark later in the trading day, but really what's your take on the STI hitting that milestone? What's bolstering the index's movement? What's the outlook ahead as well?
Well, sure. Well, as we all know, the Singapore banks, DBS, UOB, as well as OCBC, together their weight on the STI index is slightly above 50%. And as you can see, the three banks have had really, really strong year-to-date performance. So in the span of 3 months, they have respectively went up by between 4 to 6%. I think DBS is up slightly more than 6%. So obviously, if the three biggest, heaviest weight on the STI index is up, then of course you lift the entire index up. Then you've got the small players, so various REITs. One name that comes up actually quite surprisingly is of course ST Engineering, which is up about 40% year to date. But of course, its weight is about 2% on the STI index. So they didn't move the needle that much, but obviously a very good performance by homegrown STI Engineering. Reading one graphical comparison, STI Engineering year to date actually had a better performance than Tesla, or was it NVIDIA? Okay. I think it was NVIDIA. So that was pretty surprising. Now, the other macro narrative is, of course, the Singapore 2024 full-year GDP growth of 4.4% came in slightly higher than the initial estimate of 4%. So that's all good news. And, of course, there's still positive buzz around the $5 billion equity market development program by MAS that was announced last month. So the current consensus forecast for the STI is between 4,300 to 4,400 points by the end of this year. But, and it's a big but, all these forecasts and rosy pictures, that's before Trump 2.0 took over at the end of January. So it's been only slightly more than 2 months. As you can see, the risk factors have multiplied since then. The scope of the trade war is escalating. 2nd of April, next week, Wednesday, is Trump's Liberation Day, where he's going to announce more tariffs and possibly even reciprocal tariff regimes on other major trade partners. And of course, the EU and China has vowed to retaliate. So there's a lot of uncertainty right now. Very hard to read the tea leaves. I think whatever they will say today is probably going to be totally different when we talk again next Friday.
Especially so with the new, the auto tariffs as well. We've seen the impact on global markets yesterday. But zooming in on the counters to watch right here in Singapore, Ben, we've got Sinarmas Land after an entity controlled by Indonesia's billionaire Widjaja family called Lyon Investments made this voluntary, unconditional cash offer for all the shares in Sinarmas Land that it does not already own, and that is at 31 Singapore cents apiece. We saw shares of Sinarmas Land up some 21% earlier today, up 16% as I last checked, about 4+. How would you read into the counters movements then?
Okay, so it's one of those good news, bad news kind of view here. So, 31 cents is actually a premium of 12.7% over the last traded price of 27.5 cents. That was on 24th of March before the trading was halted because of this news, right? So, that's a nice premium, but that is assuming that investors have bought recently. So, but if you look at the most recent high, and that was in 2015 March, 10 years ago actually, the highest point was 76 cents. So if you compare 76 cents versus the offer price of 31 cents, that's a drawdown of more than 50%. So obviously for long-time investors that has been holding on to the stock, that's 31 cents. That's not great. But of course, if you bought the stock last week, then of course that's all good news. Now the interesting thing is that the share price today closed at 32 cents, I believe. Last checked the chart, which is of course irrational, because why would somebody pay 32 cents to sell it to the majority shareholder at 31 cents? So it's a bit silly, but I guess these investors that bought at the last minute, they're really hoping that the offer price can be improved to at least match the 32 cents. So if they matches or it goes up a little bit, then they make a few cents per share. So that's how I read into it. But it's kind of it's like trying to pick up pennies in front of a bulldozer.
Okay. Yeah. Now, another counter to watch for today, Ben, is new because the Chinese EV maker yesterday, it announced plans to raise 4 billion Hong Kong dollars or 688 million Sing dollars through a share placement for the R&D of smart EVs. Big question over here. We've seen CATL earlier. I think before that was Xiaomi and BYD, if I'm not wrong. What's up with the flurry of share sales by Chinese EV makers or Chinese tech firms of late? And what does the move mean for new investors in terms of share dilution? Okay, so I guess we need to zoom out and look at the overall macro narrative. So for the last few years, there's been an ongoing war, actually, bloodbath in the Chinese domestic EV market. So there's rampant price competition. Not many people are making money. So, initially a couple of years ago, there were hundreds of EV makers. It's been whittled down quite a fair bit. NIO is one of the smaller ones, but of course, BYD is a clear market leader. And of course, recently they announced a new battery that charges at 10 times the rate of nominal capacity. I mean, in reality, what it means is that, you can fully charge a battery in 6 minutes. That's twice as fast as Tesla's supercharger. So BYD is the, far and away market leader and favorite. All others are playing catch up. Now, if you look at NIO stated that they need to raise funds to invest in R&D. Definitely they have to do that because the battery is the key technology, right? It's not the motor or the tires and all that. So they have to do that. But more worrying is that the company has also flagged that their balance sheet is a little bit soft because as of December 2024, the current liabilities was more than the current assets, which means that accounting-wise, the quick ratio is a negative amount, which is not good from a financial statement analysis position. So they need to quickly take a look at that. And of course, what is also not good, the negative news, is that the new shares were offered at a discounted price of Hong Kong dollars 29.46 versus the last 32, was it?
Closing price. Yeah, 32.55. So it was about 9.5% discount. So obviously, if your company is doing well, you're not going to issue new shares at a discount, right? So you've got a double whammy here. So you've got a lower market capitalization because, the price has dropped because of, discount prices. And the other thing is you've got another 137 million more shares in circulation. So definitely there's going to be share dilution. And again, it's going to be like a death spiral, right? So existing shareholders will feel even more upset, and they might, even cash out. So, the price is probably going to be more downside risk than upside potential.
Okay. Now, if you're just tuning in, we're in conversation with Benjamin Goh, Head of Research and Investor Education at SIAS. Across the region, Ben, big swings in stock markets and hedge fund activity, they have propelled Hong Kong's derivative trading to unprecedented highs. I mean, if we look at the number of outstanding futures and option contracts on the city's bourse, that has reached 22 million so far this year, surpassing the record set in 2024 by 70% in less than 3 months. What does it mean for investors right here in Singapore? And would you be concerned about the risks? Are there things that investors should know about?
Well, sure. So, interest in derivatives tend to pick up when the underlying cash equities market is volatile.
Yeah.
So as you can see, the Chinese as well as Hong Kong stock market has been a bit of a wild ride simply because of what's been happening with the tech sector as well as policy coming out of China. So it's been up, down, up, so on and so forth. So it does make sense that the derivatives trading volume is skyrocketing in the Hong Kong market, right? But then again, if you look at the data a little bit more, most of the new derivatives trading volume is actually in options of Chinese tech companies like Tencent, Alibaba, and Xiaomi. And that really is, does make quite a lot of sense because when we talk about options is like, just to be a little bit more law to make sure that everyone understands this. Options is like insurance, right? So if you have to claim insurance, then the sky's the limit. So you claim for accident, claim for eye pain, I lost my 2 thumbs, leg pain, cancer, just claim for everything, right? But the cost of insurance is constrained, is limited, right? You just pay the price of the insurance policy. Options is the same thing. Generally, if you buy options, you've got unlimited upside, but the downside risk is confined to what we call the option price, or in the taxonomy used in the finance industry, it's called the option premium. Yep. And of course, you've got leverage. So which means that it is very possible for everyday people to make really outsized profits with, really small upfront capital and in low cost. And then you also have got the institutional investors like funds. They also use derivatives to hedge their long positions. So which means that it's kind of like a dog trying to catch its own tail, right? So if you've got volatile underlying, it leads to higher trading derivatives market, which leads to higher trading volumes.
Is this like a never-ending cycle? Right to say that?
Until the party ends, until the song ends.
Okay.
So derivatives is like supercharging your car. You can move very fast, but the crash also will be quite spectacular. And I think that's where the issue is. So the challenge is that the music will have to stop sometime because you can't go on forever. And whatever crash that might result from this is probably going to tar the entire Asian market. So negative sentiment is probably going to spill over to the Singapore market. But of course, it's not a homegrown issue. So there will be other factors affecting the STI index.
Okay.
And the last thing is, of course, you asked about what investors should know about. Well, I mean, if you are a Singapore investor and you are investing in Hong Kong derivatives, I guess what I can say is that please don't use money that you can that you can't afford to use. Afford to lose, I beg your pardon.
Okay. Now, further away, banned gold prices scaled a record peak today as concerns over U.S. President Donald Trump's fresh tariff plans ignited fears of a global trade war, driving that rush towards the safe haven allure of gold. So if you look at gold prices, spot gold climbed 0.2% to $3,061 and 72 cents an ounce at about 8:35 a.m. Singapore time. So what are the levels to watch for the bullion then?
It's actually up. Remember 2 weeks ago we spoke about gold and it just crossed 3K, right? Yeah, so right now, so the number you gave was 3061. Well, it's actually up. Spot gold is now 3073. That was a few minutes ago. And gold futures contract for June delivery is actually now at 3115 per ounce. What it means is that the market expects gold price to be at 3115 per ounce in June. Okay, so as you can see, right, the gold has always been seen as a safe haven asset. So whatever that's happening right now, you've got the escalating trade war, you've got the uncertainty of any kind of equitable Ukraine peace deal, you've got rising rhetoric from the EU and Canada about strengthening their relationship, their supply chains away from the US. all that is, really hitting the demand for gold. So you've got everyday people stocking up. You've got funds stocking up. You also have got the usual central bank buying policies, buying up gold. So, I wouldn't be surprised if gold hits $3,300 per ounce by the end of 2025. I mean, we might even get there earlier.
And a quick one before we let you go, Ben. We have the latest US PCE Price Index, or the Fed's preferred inflation gauge, due tonight. What are you expecting on this front? I believe expectations are for 2.5% on the year for February. And how far can we rely upon the numbers as a precursor on what's to come for U.S. consumer prices? Because ultimately those tariffs, reciprocal tariffs that we talked about, are only going to kick in next week onwards.
Sure. Well, tonight's PCE reading is likely to remain steady about 2.5% year on year. If you strip out the food and energy prices, so we're talking about core inflation here, that might rise a little bit to 2.7% for February from January's 2.6%. And the reason why they rise, is a bit flat and not so strong is because the inflationary impact of the trade war is not showing up in the data yet. So remember, Trump came to power at the end of January, right? So the numbers are not in. Now, if longer term out, we are likely to see an increase in inflation to maybe 1.5% to 2% in the U.S. over the next 2 to 3 years time frame. So it's not going to be immediate, but it's going to gradually, creep up. So already you can see food prices as well as prices for shelter, that means rent, edging up. So the mantra that the Fed has been saying in the last week or so about higher for longer, I think that's pretty much concrete, unless something drastic changes in the global tariff war. So right now, all bets will be off by next week because Wednesday next week is Liberation Day. So things may change drastically.
Okay, we shall see what happens next. Thanks so much, Ben. That was Benjamin Goh, Head of Research and Investor Education at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.